A really common liability that we're going to have to classify are loans and mortgages. So just let's use an example. Let's say we go and borrow $10,000 and it's repayable in even installments over the next 5 years. And the interest rate is 10%. So the first thing to realize with a loan is there's kind of two parts to it. So let's take the $10,000 loan. So we've got 10 1,000 blocks here. That is called the principal. That is the actual amount borrowed that we have to repay. And that is the liability, this bit here, the 10,000 that we borrowed. What about the interest? So 10% interest on a $10,000 loan, that's going to be $1,000 here. That is actually not part of this because this is not a liability. We're talking about classifying things in the balance sheet. The only thing that go on the balance sheet are assets, liabilities, and owner's equity. This interest is something else. It's the bank's fee for providing the loan, and it's actually an expense and won't be included in the liability. So we're going to forget about this for this topic while we're doing balance sheets. This will pop up. It needs to be recorded, but it's an expense. It'll go in a report called the income statement. But for now, we're just going to worry about, well, how do I classify the principal, the amount that I borrowed? So let's have a look at that. It's simple. We just say, what is the amount due within the next 12 months? And what is the amount due beyond the next 12 months? And all we do, so we're just looking at an example, $10,000 loan, repayable over 5 years. The interest, well, that's irrelevant. It's just there to confuse you. You don't need it right now. We just say, okay, here's year 1, year 2, year 3, year 4, year 5. And what we're going to do is say, well, it's 5 years, 10,000. That's we're going to repay $2,000 in every single year. Okay, so as of today, let's say this is today here, what is due within the next 12 months? Just this bit, the $2,000, so that is a current liability. What is due after the next 12 months? So if this is today here, well, what's due after 12 months is all of that. So we would say that is a non-current liability of $8,000. So that's relatively straightforward. The problem is, well, there's actually two types of loans. So over time, this kind of affects what we do. Now, by far the most common that we'll do, and in fact, it might even be the only one that we do, is what's called an installment loan or mortgage. And the way that works is the business makes scheduled repayments of the principal throughout its life. So let's take business XYZ, borrows $10,000 repayable over 5 years. Well, what that means is what we just said. We're going to repay $2,000 every year. So how would this be classified in the balance sheet? Well, it's different as time goes by. So if we're at the start of year 1, the amount that is current is this bit here. So that's 2,000. Okay, the amount that is non-current is everything after that. So that's 8,000. And that adds up to 10. But because this is an installment loan, after a year, we've paid this bit. We only owe this bit. And we would say from here, the next 12 months would be this part. So that's 2,000. And then after 12 months, we've got 2, 2, and 2. That's 6,000. Now we've paid another installment, so that goes. So in year 3, the amount that's current is this bit, which is 2,000. And then we've got this bit that is non-current of 4,000. Pay that installment off. Year 4, it's an even split now. Half is current, half is non-current. And in year 5, well, there's only a current liability because after 12 months, this loan will be fully paid off. We'll have paid all the installments, so we put 0 there. So look, that might be the only type of loan we do, to be honest, but maybe, just maybe, we get an interest-only loan or mortgage. And how that works is the business doesn't pay the principal of the loan until the end of the loan. What does that mean? Well, it means it just pays the interest. And we said interest doesn't need to go on the balance sheet because it's an expense. So let's take the same example. Business XYZ borrows $10,000, but let's just say it's an interest-only loan, repayable after 5 years. What does that look like? Well, here's our time frame again. It's in the first 4 years, we're only going to pay the interest. We're not going to repay the principal of the loan. So that would be 0, 0, 0, 0, and then at the end of year 5, we'll pay all $10,000. So therefore, our loan is actually a little simpler to classify here, but each year, because what we say, what's due in year 1? 0, so current is 0. What's due after year 1? $10,000. Now it's all due here, but that doesn't matter. We're just saying what's due after the next 12 months. So that's 10,000. Year 2, it's the same. Year 3, it's the same. Year 4, it's the same because it's an interest-only loan. When it actually changes is in that last year, because in the last year, we're going to pay the full principal at the end of the loan. So it swaps. So now the $10,000 becomes current and we have none that are current. So this is called an interest-only loan. Just look out for it. It's very, very rare in our course. I can't recall seeing it at all, actually, but it could come up. So just be aware of the two types of loans.